Would I buy this business? You know what? I actually had the chance to buy this business. I probably fiddled around with it too much. I really regret not buying this business now. Let's dive into it. Okay, so I think I do regret buying this business in hindsight, but at the time I just couldn't get the fundamentals right. This is a 3PL, and 3PLs generally fall under the logistics segment. Logistics businesses can sell for 4 to 6 times earnings because they're often very asset heavy. So a lot of the value of the business is comprised of tangible assets, so quite easy to fund. The reason why we really like this business is because we're a customer of this business. So one of my businesses has been a customer with this business for about 2 years. And it was a really nice acquisition, just built out a little bit of the vertical, which we wanted to start doing with this business. And it made sense. We spend about 200 grand a year on this business, basically in storage and picking and packing fees. It's a very young business as well, so it's really only been trading now for about 3.5 years. But as you can see here, the top line revenue, they started in 2023, almost $500,000, up to $1 million, and then up to 1.3 million. And this is when we really started looking at the business, was middle of 2026. And certain things have started to change. The one thing that's lovely about this business is just look at how consistent this gross profit is. It's insanely consistent. The second thing that's great about this business is, regardless of how the customers are performing, the storage fee is effectively fixed and recurring every month. The third thing that's great about this business is there was room to grow. This was operating at about 50% capacity. So we knew we could probably push this up to the low 2 millions in terms of revenue without really any further CapEx investment. So why did we pull out? Well, the truth is we didn't actually pull out. The truth is we had a little bit of paralysis because we knew some facts about the business that would affect its underlying performance. We knew that there was a couple of customers who were going to be leaving. And at that time, the particular industry that this business is in was also quite volatile and uncertain. And so we were probably being a little bit overly cautious, but again, the fundamentals just weren't there. So if we break this down, in 2025, we've got an underlying EBITDA of around 394,000. So a really healthy business. And our offer was going to be up around the 1.4 million. Effectively on a walk-in, walk-out basis. Another great thing about this business is it was fully managed. So they had a general manager in place who was there day to day. We dealt with him as one of his customers. Lovely guy. However, the transition that was happening in the business, there were two things that were happening. Number one, the business had reached a little bit of a ceiling. It did need an extra role. It needed an extra hire. And to get someone really that was going to be quality and sustainable in the business was about an extra 150 grand. And you probably would absorb that expense immediately before you're starting to see efficiencies in the top line in the next 12 months or so. So that was going to be a consideration for us, and that brought certainly the short-term underlying profit down. But then when we looked at the customer base, and we weren't interested in who the customers were, a lot of them were our competitors, but that was a really big tell for us. So if we're working off roughly $400,000 underlying earnings, we've got roughly $1.3 million in top line revenue. The business should be doing about, let's just say, $115,000 a month just to maintain where it is. If we then build in one more labor cost, this comes down quite considerably to roughly $250,000 for the first 12 months before we start seeing greater efficiencies and perhaps a little bit more growth. When we focused on the quality of earnings, this is where things sort of started to get a little bit alarming. So number one, they'd lost their major customer. And this is just a summary of a quality of earnings assessment that we've done. There's a lot more data that feeds into this, but this is a really important thing to do, especially when you're dealing with recurring revenue. You've got to do quality of earnings on a customer by customer basis. And so anything in red is either left or the customer is actually going backwards. This is us here. And you can see we spent about 230 grand with that business in the last 12 months. And any customer that's red is going backwards. And what we've really sort of looked at is what's their 3-month average spend and which customers are heading forwards and which customers are heading backwards. So any customer here this is effectively the variance on their rolling average prior to this 3-month average. So you could see that there was a good chunk of the customer base that was actually heading in the right direction, but we've also had customer number 1 leave, 3 other customers who are going backwards, very little movements with a couple of minor customers, and another customer has actually just left as well. So what we looked at and said, okay, well, in FY25, you roughly should be doing about $115,000 currently, and what we expect to occur in the next couple of months, your revenue is going to drop now to $93,000. So if we think about that, we're talking about another $20,000 swing, and that brings the underlying profit down again. And so it probably was a little bit short-sighted in some ways, because we wanted to go back to the negotiating table with this evidence and say, look, we've got to buy the future of this business. We can't pay you for what you've done historically. This is the state of the business at the moment. The seller, we actually still have a great relationship, but the seller, rightly so, they had a bit of a target in mind, and they wanted to play the field and see what else was out there. We stayed in touch with the seller over the next, couple of months, but he basically went a little bit quiet. Eventually we got an email from the buyer saying, hi, we've just bought this company and we hope you stay on as a customer. And we still have stayed on as a customer. We've got a great relationship with them now. We've been successful in negotiating some lower rates, but it's one business I sort of wish we bought.